Good afternoon. May I suggest for the one who are behind to come in the front because the screens are quite small. Might be easier. So this session perhaps at 4 p.m. in the afternoon might be a bit difficult, but it's something that is impacting all reinsurers and all insurers, is all the regulatory changes happening in Bermuda, Europe, Asia. And, in the pricing in this kind of business or the financial result of the business, understanding this regulation on the will impact or are currently impacting lifers, non-lifers, and so on, it could be of interest. So with my colleague Jessica Parra, we are going to go through what we see worldwide. So Fidelity is a global asset manager. If you're US, certainly you know it. It's the largest one. When we add all business, Fidelity globally is $19 trillion. 25% of the Americans have their retirement with Fidelity. It's privately owned, so it's not well known, but it's privately owned. And we manage for money not only for people, but also for insurers, reinsurers worldwide from US to Japan. The click up. The idea really is to look first at the prudential regulation, which have currently a big impact, and the prudential regulation are changing in many countries. In the UK, they're changing currently for lifers. In Europe, next year, there will be the implementation of the review of Solvency II, which is going to impact non-lifers, reinsurers, and lifers. Bermuda is also changing currently their regulation, which is impacting everybody. ASEAN is transitioning everywhere. So last year it was Singapore, in July it was Hong Kong. There has been CIROS in China, there have been KICS in Korea. And end of next year there will be Taiwan, Japan. So if you are in the insurance business or advising, all of that has a big impact because lifers, they need to change their model everywhere in the world. They need to work with private equities, they need to work with reinsurers to change their business. Non-lifers and so on, they need to think what to do, where to do, because all this constraint makes the return on capital you get from your model will be impacted by your localization. And also there is, when you manage asset, and what we are going to do, of course, is all the financial results, there is always a part coming from your financial asset. You need a lot of information. Something as well that's already impacting continental Europe are the ESG regulation, making the constraints of the management of insurer on both liability and asset with a lot of constraints. So climate stress test, today, insurer, when they want to underwrite new business, they need really to think, okay, does it make sense? I'm a shareholder, are going to accept that or not? So it's not only the asset side, there is also the underwriting. Exclusion of sectors as well is impacting. So it means other parts of the world could benefit from some insurers in the Occidental country leaving some markets. And you will see many ASEAN or other taking over this business that Occidental country are leaving out because of these rules. Decarbonization as well, all the impacts in Europe, but also in Asia. Some countries start as well, like Hong Kong, China, looking a lot at that. And accounting changes here is mostly for Asia. So if it's too simple or too much complex, feel free to to ask or to question. If you look globally, insurers in their ocean of regulation, there are some regulation on the end client side, there are some regulation at the insurance level, at the agents level, the brokers level, there are regulation on the investment side. I will focus most of the discussion on the investment side because here today has a more and more impact on the financial results of the company because it's reducing the investment universe or it's forced really to manage differently. For example, ESG. In Europe today, continental Europe, but it's going to move in Asia as well. I'm advisor of the Chinese regulator, the Taiwanese regulator, and the Hong Kongese regulator, and they're going to do like Europe because Asia is doing like continental Europe. Not like UK or US, like continental Europe. And they want to implement something where in risk management, investment, underwriting management, you need to take in account all ESG metrics. So tomorrow, if you are investing in something, you need to be careful. If you want to go on a new underwriting, you need to think where I'm going, because from a global entity level, they want to impose all the insurer and insurer not to cover certain sectors, so that these sectors start disappearing. You know, if you are, some of you are Londoner, you may know that in London, with the diesel car is impossible. In Europe, you know, the ESG rules are very, very strict. If you are living outside of Europe, is, I would say, normal life. But there are a lot of rules making that, first here is impacting the governance, the responsibility as well. You know, in continental Europe, when you are insuring a specific business which is going to pollute, you start being responsible of the pollution of the corporate. For example, in Italy, IVAS has created this regulation. So really making that when you invest the money, where you underwrite, why are you underwriting? And why? So the responsibilities, it could be penal as well. The way of thinking about ESG makes today is that some insurers are excluding specific sector on underwriting an asset. So, I mean, we see that with our clients in continental Europe. You know, they exclude all company, you know, going on fossil fuel. As suddenly everybody, no one is no more using fossil fuel. And the same of the financing. So you find we are in the world now where I see insurer outside of Europe coming to do business in Europe because the European insurer don't do it anymore. So you see this strange happening, you know. So, you know, 10-15% of the world are already ESG, the rest, it's not their problem. So you see really this deglobalization as well in investment in insurance. So here under Solvency II, but the same in Asia and so on. For example, on ESG, insurers need to check how their business on asset and liability are going to be impacted by climate stress test. Today, there is no capital provision, but tomorrow there will be some capital provision in continental Europe. Governance, all the function of insurance need to take care of that. You remember 10 years ago it was not at all the case, but today it is. The transparency as well is very important. So transparency, you know, you mean insurers in continental Europe need to give a lot of information on ESG. You know, what is the pollution of my portfolio, of my underwriting, and so on. And then after the shareholder, the client stack could attack the insurer and so on. So it makes that the insurer have a specific behavior. Yeah. And here you see Asian insurer and insurer, what I see, coming in business that local insurer in Europe stop doing. Because well, the rest of the world goes on living the same way. I will not go through the regulation here, but only to give an idea of the pipeline of regulation on ESG only, through Europe and APAC. You see, that's the quantity of regulation going to happen in the coming years. Okay, so of course what we see many asset manager insurer, I optimize not to be impacted by this regulation. That's the way it works in our, you know, in insurance world. We know that everything is about optimization, and there is no coordination between all these people. So now let's move on with Jessica on the next part.
Get the microphone. Hi, everyone. So we wanted to talk here a little bit about how we look at climate risk, the fact that climate risk has an impact on the capital market assumptions, which is basically the returns of the different asset classes. So our analysts have done modeling on potential implications of climate risk on different levels, on how it affects GDP, how it affects inflation, and how it affects interest rates. So if you look at this table, for example, we took 6 different potential scenarios where you see 3 big areas where they follow, when the companies follow, we are under our orderly transition, a disorderly or a hothouse case. And you can see clearly that depending on each of these scenarios, they will have different impact on asset classes. If we look, for example, on fixed income and the delayed transition scenario, you can see that their returns are negatively impacted. And you can see also that happening on the hothouse scenario for equities. So we think this is going to be an issue happening in the next 10 years. So this is something to be very much aware of, that this climate risk will impact your returns, the volatility, dispersion, and that means that you really need to be very active on the management of your assets. Another area to consider is the need for decarbonizing the assets portfolio and how that impacts the returns. As you know, many companies have signed pledges to follow Paris-aligned net zero by 2050. And with that, if you are one of those firms, one of the things you need to make sure is that all the corporates that are part of your investment portfolio are also, where is the position towards net zero? And it's very important to consider that this is not only a quantitative issue, to understand how much emissions your issuers are emitting now, but it's also a qualitative issue because you need to do deep research to understand how this issuer is going to behave over the next years. So you need to have proper research to understand that situation. If you see at this table, what we've done is proprietary climate ratings, where we group issuers depending on the evidence towards transition. So you have corporates that have no evidence of transitioning, and then you will have different levels up to corporates where we believe that they will be achieving net zero goals. And that's what we use when we put together an investment portfolio. So the main point here is that you need a forward-looking approach and to understand what is the plan of these issuers. Are they going to deliver in that plan? And can I consider that as part of my investment portfolio? So you might start in something like this, where you have, some corporates on the red bucket, but ideally, you need to move towards the companies that are aligned on the good behaving issuers. A key area to consider is also that all these ESG regulations are impacting the investment universe that you have available to incorporate in your portfolios. So if you look at all these, all this net of different regulations, you'll see that if you start by the biggest circle, you have the do no significant harm standards, where you exclude some sectors like tobacco and fossil oils. And then you have another universe that is more restricted, which considers only companies with good ESG characteristics. So this is only looking at how companies operate. So companies with good MSCI, for example, scores above triple B. And then you move towards even a more restricted universe, which is sustainable investment. And that universe considers only what the company is doing, and it considers only companies that have a positive impact or contribution towards an environment or social goal. And then, even further, if you move towards the EU taxonomy aligned investments. So if you start incorporating all these different regulations, your investment universe becomes quite restricted. This is not the case now. It can be the case of the future. For example, we look at a case with a client where we look at their existing portfolio to estimate how they were looking in terms of yield and ESG metrics. This portfolio had a return of 4.37%, and we did an optimization with our platform, and we were able to improve their return by 20 bips, and at the same time maintaining a good credit rating in overall of BBB+, maintaining the capital requirement around 10, and then more interesting, we were able to find a a more diversified portfolio and with a lower level of carbon emissions. So we think that you can still deliver good returns while including ESG considerations, but the future is going to be more constrained and is something to be very aware of. A way to overcome this obstacle is to think when you are looking at transitioning, we need to understand that a way to improve returns is to do it through engagement and stewardship. So we are very active on engaging with corporates to make sure that they are delivering on sustainable investment and objectives. And here our recommendation is to make sure that you pick up a theme that is aligned with your overall corporate strategy. Here you have different themes, within the climate, biodiversity, and society buckets. If we look, and these are all the initiatives where Fidelity as a firm is also involved with. If we consider, for example, deforestation, what we try to do is to partner and leverage with already existing industry initiatives. And we partner with RSPO and NDP, and all these acronyms just mean that they work in the palm sector, and they just try to make the production of palm oil sustainable and to make sure they are not cutting more trees. And so there are many initiatives, and what our recommendation is to, avoid exclusions of sectors, make sure you or your asset manager is engaging with the companies that you are investing in, and you are choosing the right theme that is aligned with your strategy. Okay, got it. So, and transition is not all negative. It can also be positive for some sectors, and that's the case of real estate. We've seen that when you look at refurbishment projects that focus on impact, you can obtain a greater return on investment, and you achieve a higher value of that asset, and you also lower the cost of capital. Particularly in Europe, there is a lack of green logistics and green offices, and we see that as an area of opportunity. And if you look at this slide, it has an example, 3 types of renovations. You have a standard renovation where you can extract an IRR of 8 to 10%. And then if you move towards more than an ESG renovation that is looking generally at improving ESG metrics, if you go towards impact, where you have more stricter metrics to deliver a positive impact on the environment or the society, you'll see that your CapEx is larger, so it will go from 1.5 to 3, but your return goes significantly higher to 15 to 18%. We have a case of a building where we did this in France, and what we found is that the costs per square meter without doing any work was around 500 euros, right, where you see 400 was the rent and 100 was the OPEX. And by implementing a full green refurbishment, we were able to have a rental uplift of 15%. We were able to reduce that OPEX by making the building much more energy efficient. So the operating cost went from 100 to 30, and that saving was divided between the tenant and the landlord. So it creates win-win opportunities for both the occupier and the landlord of the business. And also, which is even more interesting, is that you get almost 50% valuation uplift. So this is a sort of opportunities that we are looking at, focusing on real estate and impact, and where we think there is good good value at the moment.
So today, all the asset manager try to do that, but as well insurance. Today, the way insurers are organized in continental Europe versus UK, US, or Asia is pretty different, because all this regulation, when you put prudential and ESG, push them to do a lot of things. And asset manager is very similar. So in company, you need to have a fundamental research, but also a strong sustainability research. Because in continental Europe, the regulation asks the insurer and reinsurer to justify what they do on really not only the underwriting and classic financial research, but also from an ESG perspective. So I will not go through what it means ESG integration, but yeah, it generated a lot of work. If I look at the kind of work in continental we have been doing, but also Asia with insurer, reinsurer, sidecar, captive, a lot of ESG check, decarbonization guidance on the portfolio of both asset and sometimes also liability engagement as well, because the regulation asks the insurance world to justify what they do to convince the corporate they are investing or they are insuring to do some changes. Transitioning to new regimes. Yeah, up, sorry. I need to, in this direction, up. I take an example here, I take Taiwan. Taiwan currently is in the US framework, and they are moving to the equivalent of Solvency II in continental Europe. So they move to, I will exaggerate, to no regulation, to full regulation. Really. For them, you can imagine Japan, Korea, for all of them is a nightmare. You know? And at the same time, they do prudential, ESG, and IFRS 9 and 17. When this company never had an ALM function, never had, they don't know what is ESG apart of economic scenario generator. So we are helping them a lot in Asia, and typically all the lifer and non-lifer in this region, you know, we need reinsurer to help them, because suddenly the cost of capital is, boom, exploding. And we have the same in Thailand, Indonesia, Malaysia, and so on. No? So I will give some, it's a bit difficult because it's very small, but in practice is Taiwan today, Taiwan tomorrow. So Taiwan today, very light. Tomorrow is the European framework. So it's very complex for them to do the changes, whatever the sectors they are. And they need to do all of them at the same time. Because the international regulator AIS, as copy and paste was EIOPA has been doing in continental Europe, and all the countries of the world are putting that in place now. So what we see in all these countries is, until now, the risk management culture was pretty light. And suddenly, they need to build team to do that. They have no one. You know, when I go in all these countries, but you cannot, they did not exist. So they have a lot of work. Corporate governance, you know, the fit and proper. No word. Financial strength and resource, you know, they need to find a way to finance their capital. So they need to issue bonds, they need to do new things, they need to change their model, you know, they need to stop doing long duration life product to move to unit link. On the non-life side, they need to think in terms of short-term contract when they were doing long-term. They need to rechange everything. The way of distributing also, they could have 1,000 or, you know, in Taiwan, the 5 largest lifers have each of them 20 to 30,000 agents. It's huge. So now they need to rechange all this model. The control, reporting, you know, I've met some insurer, 100 billion, you come to ALM team, 1 person. IFRS team, 1 guy. And so and all the world is moving to that, and Africa not far as well. And so there will be a lot of job for people in all these insurer, but for the one who are a bit dynamic and want to do it, there is a lot of business to take and to do, because it's creating a lot of trouble, all this change of regulation, you know, moving from 0 to high level. Yeah, so that's some of the aspects I was just mentioning. So the insurer, the capital management, they have to do a lot of work, and they never did it. No, but really, I've seen some company where there is an actuary specified on each kind of underwriting. All the reports are different. Then no regulation was forcing them to put them together, so they cannot put that together. So how can they do an ALM? How can they do a capital management? How can they report to the regulator? So there is a massive need of help, and they don't have the people in this country. So what they do, they move to something which is very risky. They transfer a lot of risk to policyholder. On the life side, they give unit link. So in practice, they give them fund to buy. On the non-life side, they increase the premium, they diversify, and so on. So they reduce the affordability of the product to the end client suddenly. So they are destroying a lot of insurance capabilities in many countries, what I see. But that's my personal view on the ground. You will have no one saying it, but it was really happening. They need to diversify to other asset class. They are not used to do that. You know, when you're in Taiwan, it's a bit like small country like, I don't know, Sweden or others, you know, the bond market is pretty small. So when you need to invest, or your local bond or equity market is small, so you need to go to Europe, to US. But the currency edge between Taiwan and US and Taiwan and Europe is expensive. So suddenly, you create big movement of capital that are going to increase the inflation in the country because they have an impact on infix. So many regulation has been created without thinking about all these macro moves. Of course, education of network. You know, networks, they know to sell a car insurance, something insurance, a contract giving 5% to client on their life. All these new products are more complex, and they are not educated to do it. But it was the same in Europe. You know, the network in Europe or UK and so on, they were not used to sell unit link or all of that. So there is an education process everywhere. So better financial education is required everywhere. So that's a big of the aspect on the business. When we look, here I suppose you're familiar. Here that's the existing capital cost of all the asset class with the return, so the capital market assumption Jessica was mentioning, in the existing one, in the new one. So suddenly you see equity become very expensive. So what are we doing here? We stop the financing of equity in all the countries of the world. No, but that's the reality. You know, it's moved from 20% to 40%. You know, you are insured, you put your money in something else. Of course, the government are very happy because investing in govies, the capital cost is zero. But you can see from only analyzing that, you can understand the flow of money or the going to change. And from a reinsurance perspective, what you can do, because today 30 to 50% of the non-lifer performance is coming from their portfolio. For the lifers, it's 70%. So from that, you can deduce all the impacts that is going to happen or are happening. And a lot of other things. You have a lot of impact on the duration management of the portfolio. You have a lot of impact as well on the FX. It will generate a lot of negative impact in this different market. So from an asset management perspective, you need a lot of upgrade. The reporting as well. You know, in US, you don't need to report the line by line of the portfolio. So, but in the equivalent of Solvency II worldwide, you need to report all of that. So, but asset managers are not used all to provide all this information. And the corporate behind as well, they are not used to give all information. So there is a big lack of information. So there are some continental Europe, you find all this information easily, you know. But when you invest in China, in Kenya, or in South Africa, so you don't get this information, you know. And all these regulations are very punitive when you don't get the data. But you don't need always all this data. At the end, the regulator don't use them really, but they are punitive when you don't get them. Only this one. I'm coordinating in Europe a working group with all European insurers on ESG data for 3-4 years. You know, today we have created a template to exchange data. We have only 650 data points. Only on the asset side, huh? You know? And 2/3 of the data don't exist. They don't exist. You know, the regulator asks, for example, all insurance to say, oh, your investment portfolio, how is it threatening? There is a list of 1,001 threatened species. Okay? No corporate, no. You know, when you have a building here, okay, we are in a building, we don't know what there was here 100 years ago. So we don't know what we threaten. So there are some metrics that are asked, but, and we don't give it because they don't exist. But bon, it can give an idea of the, sometimes of the creativity of the politics coming to the regulator, coming to our industry, and which on the underwriting or assets, they don't exist, but they will have an impact. Here some example of the, for example, that's for lifer here in Taiwan. They wanted our help to manage, here it's a life product. Initially, in the new solvency, so ICS, their capital adequacy ratio is only 126%. Normally, under 150, you are considered as bankrupt. So it's for in 18 months. So we try to work with them to optimize it, to change it, and so on. But in the new model, that's really complex model to do it. And they don't have the people. It's not only Taiwan, it's all the many insurers in the region. That explains why you will see a lot of Japanese, Taiwanese, Korean, you know, selling part of their book through Bermuda, Cayman, and on the non-life as well. It will be exactly the same. Hong Kong, that's pretty similar as well. But in Hong Kong, they have another topic, is they put a lot of ESG regulation when half of the local insurers are linked to Chinese insurer, where everything is in, they only use coal. So it's a bit like Germany, you know. So it's another topic. Well, it's UK, France. Here only this optimization is to show that all these constraints push to more and more optimization, reduction of investment universe. And as Jessica was saying, today you can find still the return on the market, but all this prudential and ESG regulation year after year are reducing the investment universe. If you don't want to have problem with your shareholder, if you are private, it's fine. But if you are public, it's becoming really a nightmare to manage it. Because today is fine, but the real world does not change. You know, the financial regulation change quicker than the real world. It's yeah. So yeah, well, it was a bit quick, but perhaps here the idea has been really to share that today in all our business, there are more and more change of regulation. Well, if you are working with Bermuda, you know they follow more and more UK as well. So, and all this change of regulation makes that taking really in account what you do on the investment side by looking at all the solvency changes in terms of prudential, the ESG regulation and the accounting are very important and will have a big impact on your portfolio. We are following many insurers, you know, and many who are applying too much rules, their return really is suffering. If you are a non-lifers and you have good margin on your underwriting, it's fine. But when you start doing life insurance and you are lifers, but you lose competitiveness with other insurers. And at one stage, you agglomerate more risk because you are more concentrated. So, and what we see, there is really a need of reinforcement of ALM, strategic asset allocation function, more diversification, and all the aging around currency, duration, and accounting is becoming challenging, especially in the small country where there is not a deepness in terms of asset and deepness in terms of financial instrument. So that's an area where we need to take into account, but also an area of opportunities, because there are many countries where lifer and non-lifer, we need the help of reinsurer to optimize their capital. Is there any question, remark? Is there anyone from continental Europe? There are some. Are you suffering from the regulation or not? Yes? Challenging? Is there any US guy who is not suffering at all? Bermudan as well? No? Yeah? It's more quiet, yeah? No, not yet any stress. But the lifers in Bermuda start feeling the pressure. Yeah, in Solvency II? In which country? In Europe or? In Bermuda, today in Bermuda, as you know, when you take a portfolio of private debt or bond, you don't care about the duration. But in Europe, you take care about the duration. You know, you take a spread, you multiply by the number of years, making your capital charge far higher. So today, they are not looking at that. But for example, what's happening is UK PRA is asking really Bermuda to be sure that when you are insuring a book of product on life side in the UK, that all your products you are putting on your Bermudan balance sheet are transferable to UK. So they are matching adjustment eligible and so on. So that's became very restrictive. Well, there is still some advantage to do that, but there will be. And they are looking as well on the annuity side for US. They start looking as well because Bermuda is still slightly UK. So 2/3 of the business is perhaps with US, but they look at that. So that's the first change. Also, I know that the Japanese regulator start discussing with them because Japanese insurer put some part of their book in Bermuda or look Cayman. So that's where, you know, the regulator come, and because of AIS, they work a lot together. So there is still some space, but there will be some changes, yes. In the UK, the regulator as well is changing the regulation for lifers to authorize them to invest in sub-investment grade asset. But they want the money to flow into UK sub-investment grade asset. It's what we see in many countries currently. The different regulators try to modify the regulation to get the money of the insurer flowing into the local asset. They want the money to get invested locally, everywhere. There's a kind of, I don't know, nationalism, but there is a willingness really to get the money invested here. And we find that as well in Asia, where the transitional approach are to force that. Because the money has to be in some country too much diversified. In Asia, for example, when you look at the book of a Taiwanese, 60-70% is investing in US. So now the regulator, the politics want the money to be invested more locally or in Asia. And you see the same in Japan as well. You know, they stop in buying T-notes and they invest more locally or in Asia. We see more and more this deglobalization happening really in practice. And the regulation are forcing that. The same like in Europe, you know, if you are an Italian insurer, the government asks you kindly to, very kindly, or in France, you know, they gather all the insurance, they say, okay, look, if you want to have your tax reduction, you need to invest at least that in France. Otherwise, you'd lose your tax reduction. So you feel it. And Solvency II in continental Europe, they are going to make more simple the regulation. For example, the capital charge on equity will be twice cheaper next year if you invest in Europe equity. So you see Europe equity, not UK, EEA, so continental Europe. So the change are as a way, yeah. Yes?
I mean, just, you've talked a lot about regulatory changes, and I get a bit of a mixed message. It seems like they go in different directions, right? So Solvency II is simplifying, a little bit cutting red tape. We talk a lot about deglobalization, but then we also see, as you've mentioned, Asia and Africa coming closer to the European model, so maybe some kind of regulatory convergence in the world. So, I mean, what do you see happening globally? Are these regulatory changes leading to a more restrictive regulatory environment, or is there greater global fragmentation, and is there more red tape? I mean, what is kind of the final outcome, and what can governments do also, like using the G20, APEC? Is there a role for these supranational institutions to try to make sure that these regulatory changes are as business friendly?
Frankly, I don't know who's driving the regulator. You know, I don't know. The politician, I will not be polite, they are not clever enough, but I don't know who is driving the regulator. But the prudential framework in continental Europe, I would say in some sense, works well. And the regulator is identified to make it more simple. Well, but the regulator in the rest of the world outside of US and Canada, they are copying in paste the European approach, but as they don't understand it properly, they don't take all the feature, so sometimes they make it more restrictive. But at the same, you need to think as well that locally the politics, when there is a change of regulation, they want the regulation to do something specific to the country. So they are adding the rules such a way that this prudential framework at the same time push the people to invest more locally. And also they don't understand the risk of the model. Because in Europe or US, that's too big economy, with a lot of assets. So if you say to a French, German, Italian to invest in Europe, there is a big, deep equity market, a big, deep bond market, and so on. So it's easy, the same in US. But when you go in Asia, in Taiwan, one small country, or Japan, but it's one country, they don't have the breadth of the asset locally and so on. So the regulation need to be adapted, and the regulator don't understand that. They never think about the impact. If you say in the regulation, you need to currency hedge all your non-local position, automatically you are forcing the insurer to buy currency hedge. But in a market where there is not an house asset, it means they invest a lot abroad. So automatically you make you are weakening your currency. Australia, you have an impact on the currency. So the regulation itself are good, but they never take into account the macro impact they are generating. And after the politics add their local things. So I've seen in each country they say, oh, that's AIS, but in practice they take it and they tweak it, But like Solvency II, the French have adapted with volatility adjustment, the British with matching adjustment, the German, they have very long liability, so they managed to get a very high ultimate forward rate, making their liability very low. So each one is arbitrating, So you need to go, the evil is in the details of the regulation. And that's where you change everything. If you take your liability and you actualize with 6% rate, of course, you have no liability. If you put it with 2%, it changes everything. So, but the regulator or the politics, they don't understand really that. So in practice, that's where the differences are coming. And deglobalization is naturally coming from the fact that there are some markets that are growing and others that are not growing, and also because of this currency, now for a Taiwanese, it's better to invest in a country where the differential of rate is closer to them. Because buying a US asset and hedging back costs a lot, because there is a big difference between the rate in US and in Taiwan. So for them, it's cheaper to buy a bond in Hong Kong or buy a bond and so on than in US. So naturally, they will not invest in US because of the currency hedge. The same for Japanese. And that's the market effect. But the people who are creating the regulations, they don't think. For example, Solvency II was created when the rates were very low, but never when the rates were negative or when they were very high. So they are not calibrated on that. Because in the regulator as well, people, they don't always come from the industry. So you need to have had a few crises to understand how it works. Does it answer your... Any remark? You want?
I just wanted to ask you to develop this point about localization.
About?
About localization and delocalization. Because one of the policy objectives of the UK government, and I think as well for Europe, is to encourage particularly life insurers to invest in the green transition. And so they've made some changes to the rules in the UK, matching adjustment rules, changed the risk margin rules, have changed a bit. And the idea is that will free up longer term investment in projects which will help the green transition. So I wonder whether you don't think that would actually help improve choices of asset investment, be it they're designed to improve the UK economy or the European economy, but they're designed to generate growth and therefore returns to insurers as well as helping with the green transition.
But the change of regulation works well. I give an example, the infrastructure. In 2016 or 17, they changed the capital charge for infrastructure in Europe, debt and equity. And the flow of money to infrastructure, debt, equity was very high. During the 5 last year, there have been more money injected by insurers than there are projects. So it works. So of course, if you reduce the capital charge, but you need to as well to have the projects. And today there is a lack of infrastructure project. Why? Because all the energy companies like BP, Total, and so on, because of the pressure of shareholder, They do themselves the infrastructure project. They finance themselves. Say, look, I'm green. Look, I'm financing that. So there is lack now of infrastructure project for insurer because of that. So changing the regulation works well. After for the long-term equity in continental Europe, it's written you have to invest in EEA, cooperate with an headquarter in continental Europe. And here the capital charge is 22% instead of 39%. And they do that. If in the UK the regulator does the same regulation, it will work. But in the UK is a strange case because the PRA has been they are not applying Solvency II. They are gold-plated Solvency II. In continental Europe, it's easier. Insurers invest whatever they want, and each year they explain to the regulator what they have done. In the UK, before you do something, you need to write to the regulator, to PRA, I would like to invest here. And you wait for 6 months. If they don't answer, it means they agree. Of course, the market opportunity is lost. But it could have an impact. It's only to the PRA to let it happen. But I understand that everything around the sandbox and the sub-investment grade possibility is to say if the assets are in UK. So it will help. After the politics and PRA really need to understand how it works, how to open it. There's a lobby of big asset manager and so on that could... Any remark, question? You are all happy with the regulation everywhere? But today is 2/3 of job as asset manager. We see that is reinsurer, insurer. They come and say, okay, that's the regulation we have. In the part, how do we manage to optimize that? And you cannot imagine the large crossover companies that are doing business in many countries where at the same time they need to optimize under three regulations, making that it's pretty difficult. But thank you for your time. Have a good afternoon.